Are you looking at purchasing an investment property? In this video, I'll go through 10 things you may not have considered when purchasing a buy-to-let property. Hi, if we haven't met before, my name's Dan and I'm a CMAP qualified mortgage and protection advisor. This video is purely for educational purposes only and should not be seen as advice or recommendation to act. And I must stress, as a mortgage is secured against your property, it could be repossessed if you do not keep up with the repayments. Before I get started, I must stress some mortgages on investment properties are regulated by the FCA. And this video is purely based on buy-to-let mortgages that are not regulated by the FCA. Please seek professional advice before applying for a buy-to-let mortgage on an investment property. And lastly, at the time of recording, the information in this video was accurate, but is subject to change. With that out of the way, on with the video. So, know the area you're buying in. It might be tempting to snap up a bargain in a different part of the country, but be careful as not being familiar with the area can lead to serious losses. Not knowing the area you're buying in is potentially asking for trouble. Consider the type of tenants in the area. Is there likely to be a demand from young professionals, young families or students? So depending on the area's demand depends on what type of tenants you're likely to be dealing with. This can also affect saleability further down the line. Seek professional advice before cashing in your pension. If you're thinking about cashing in your pension pot to acquire a buy-to-let property, be careful. Only the first 25% of your pension will be tax-free if you withdraw it. The rest will be subject to income tax. You'll have to pay stamp duty on the property you buy, tax on your rental income, and eventually capital gains tax if you sell. If you leave the house to your loved ones when you die, the property will be subject to inheritance tax, while your pension isn't normally liable for inheritance tax. But please speak to a tax advisor because this isn't an area I'm an expert in. Mortgage fees can be a shocker. One of the biggest reactions I get from clients when discussing buy-to-lets is the fees. Some of the fees and the interest rates for buy-to-let mortgages can be higher than for a standard mortgage. For example, a product fee can be around £2,000 or 1.5% of the mortgage borrowing. These mortgages are usually offered with an interest-only option, meaning the monthly amount you pay to the lender will be lower than for a repayment mortgage. This can be attractive, but of course means you're not reducing the mortgage itself and can cost more in the long run. Having said that, these mortgages often give you the flexibility to pay off part of the loan each year. That's something you might do if your rentals become more profitable further down the line. If you do take this route, check for penalty fees. An alternative is to remortgage onto capital and repayment after a number of years or after the period of your initial rate expires, avoiding any potential penalties. But please do take into consideration that you'll have to stump up more fees, you'll be older, and there's no guarantee that the figures will stack up, particularly if interest rates rise. At the end of the day, you can sell the property to repay back the mortgage, but if prices fall and the proceeds don't cover the outstanding debt, you'll have to make up the difference yourself. So it's worth building up a financial cushion so you can sleep easy at night. Not all properties are going to work for you. In order to secure finance for a buy-to-let mortgage, you need to demonstrate that renting out the property will be profitable. One way of calculating rental yields is to take the yearly rental income of a property and divide this by the amount you paid for the property and then multiply the figure by 100 to get the percentage. Or you can cheat and use an online rental yield calculator. Don't forget about all the other pesky costs such as maintenance, insurance costs and any management agent fees, mortgage interest plus periods in which the property might sit empty. This all eats away at your rental yield. You'll also need to show that you can still pay the mortgage if interest rates go up. This is called a stress test. If you're a basic rate taxpayer, the rent has to be 125% of the interest, calculated at a rate of around 5.5%. This rises to 145% for those in higher tax brackets, although there are exceptions, so you need to speak with the lender directly or speak with a mortgage professional such as myself. At the time of recording, a buy-to-let is also subject to capital gains tax if you sell the property. This is charged at a rate of 28% for higher rate taxpayers or 18% for basic rate taxpayers on any increase in the value since you bought it. If you're a basic rate taxpayer, bear in mind that the gain will be added to your income, so this could push you into a higher rate band. Again, speak with a tax advisor, they're worth their weight in gold. If you're liking the content so far and you think that others will find this helpful, please press the like button down below. It tells YouTube to show this video to more people. If you're on a mobile, you'll need to rotate it to portrait. Age is nothing but a number. While lenders normally have upper age limits, either for the age at application or age at the end of the mortgage, these are higher than you might imagine. Some, for example, will stipulate that the loan must be finished by the time you're 75, 85 or 90. There are even lenders that allow you to take out a mortgage over 40 years at the age of 70 and above. So don't panic if you're sporting a wrinkle or two. You should have the same opportunities as generations below you. Something to note is that specialist lenders tend to be more flexible than some of the big banks and building societies. Owning a property already is ideal. In theory, it is possible for first-time buyers to get a buy-to-let mortgage, but in reality, it's extremely difficult as lenders often consider this group of borrowers too risky. A lot of lenders avoid lending to first-time buyers for plausibility reasons as well. The lender looks carefully at the applicant's circumstances and reasons why they want to purchase a buy-to-let without owning their own home at the time. As it has been known for applicants to attempt something known in the industry as a backdoor residential. This is where someone tries to purchase a property as a buy-to-let because they do not have the income to support a residential mortgage. To prevent this, lenders have put measures in place such as stress testing the applicant's income to check they could afford the property as a residential before lending as a buy-to-let. You typically also need to earn at least £25,000 a year. The deposits are rather large. With a standard mortgage, you can secure a property with a deposit as little as 5% of the property price. The minimum deposit for a buy-to-let mortgage is usually 25%. Although you're likely to get a lower interest rate if you can stamp up 40%, but the flip side to this is it's often advantageous to put in as little as possible as you'll get better returns. But I'll save that for another video if I'm feeling brave. Owning a limited company. Firstly, for the love of God, speak to a tax advisor. Don't take what I say as gospel. I don't know your tax affairs and I'm not qualified, so do yourself a favour and speak to a tax advisor before acting on what I'm about to say. With quite a lot of my clients, they've been advised to purchase properties through a limited company, as there can be tax advantages in doing so. If the property is owned by a company, all the costs, including mortgage interest payments, can be deducted as business expenses. The company pays corporation tax on profits, which is currently set at 19%. You can then draw income in the form of dividends. The first $2,000 of dividends is tax-free, but you pay tax on further withdrawals at 7.5% as a basic taxpayer, 32.5% if you fall into the higher rate bracket, or 38.1% for additional rate taxpayers. One advantage of having a limited company is that you only have to take out the money at the time that suits you. Although you will have corporation tax, you won't have any personal income tax. Limited company buy-to-let rates are often higher than if you own the property in your own name, but there are tax advantages that can offset these costs. There are legal loopholes you can take advantage of that a qualified person will be able to advise on, so I shan't steal all the glory and I'll let them be the unsung hero and tell you if you're able to do so. Stamp duty. Whilst we're on the subject of tax, let's talk about everyone's favourite tax, stamp duty. In April 2016, the government imposed a 3% stamp duty surcharge on second homes and buy-to-let properties in England, Wales and Northern Ireland. In Scotland, second homeowners and buy-to-let landlords have to pay an extra 4% in stamp duty. So buying a rental property worth $300,000 in England, Wales or Northern Ireland, you'll be paying £14,000 in stamp duty. In contrast, a first-time buyer buying a property as their main home wouldn't pay a penny in tax and a homeowner would pay just $5,000. At the time of recording, there is a temporary stamp duty rate reduction, but I have put on screen the rates after the 30th of September 2021. Ouch. Moving on swiftly. Time and effort. Over recent years, the desire to invest in buy-to-lets has faded significantly after a variety of government measures made it less attractive investment than it used to be. Some landlords have decided to drop out and sell up as new fees and the loss of tax relief has narrowed profit margins. Investing in buy-to-let can carry significant risks and is only suitable for people who have financial cushion to soak up unforeseen costs. It can be nerve-wracking and take up a lot of time. For some people, it's simply the wrong kind of investment and they'd be better off looking elsewhere. Stock market funds that you can buy easily online and are expertly managed are arguably much simpler to deal with than buy-to-let, where you have to apply for a mortgage, buy the property, respond to calls about a broken light bulb and deal with the occasional needy tenant. On the other hand, there is still money to be made in buy-to-let, and owning actual bricks and mortar can be very exciting. Please remember, as a mortgage is secured against your property, it could be repossessed if you do not keep up with the mortgage repayments. If you found this video helpful, please hit that like button. It really does help me out. Watch this video on how to buy an investment property. Thank you very much for watching, and I'll see you next week.